INFI, the Future of Finance, Episode 1.
Welcome to INFI, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Welcome, everyone, to this inaugural episode of the rebranded podcast. What was formerly Founders Forum is now INFI, the Future of Finance. So if you are a fan of the Founders Forum, you're still going to love this new podcast. Really, what we're doing is just refining the focus as to the scope of the conversations we're going to be having. Specifically, as Infineo has been growing, we've been fortunate to connect with business pioneers in finance, asset management, technology, life insurance, and related sectors. And we see an opportunity here to have exciting conversations about the future of finance and money management driven by technology. So again, what we're doing is related to, it's a refinement of the podcast episodes you've come to know and love through Founders Forum. But we thought the new title of INFI, the Future of Finance, was a better focus on exactly what it is that we're going to be exploring in these episodes. Having said all that, I am very pleased to introduce you to our inaugural guest, a friend of Infineo, Anthony Moro, who's the Chief Executive Officer of Provenance Blockchain Foundation. So Anthony joined the foundation in July of 2022 to lead the expansion of the Provenance blockchain ecosystem and to enable financial institutions globally to realize the benefits of blockchain. Just a little bit more about his background, and then I'll circle back and explain a little bit about what Provenance does. So previously, Anthony held various senior executive roles over his 2-decade career at BNY Mellon, including managing one of BNY Mellon's most profitable businesses, the DR Group, which made up over 800 issuer relationships from 73 countries. And more recently, Anthony was president of ROX Financial, an asset management fintech focused on democratizing access to commercial real estate through innovative New York Stock Exchange listed REIT securities. In addition to his role at Provenance Blockchain Foundation, Anthony is also an advisor to Banyan and Security. And a little bit more about blockchain. Of course, we're going to get into this early on in the discussion, but just in terms of their official description, created in 2018, Provenance is a public open source blockchain that enables more than 60 financial institutions, fintechs, DeFi brands, as well as a number of banks and credit unions to actively issue, manage, and transact real-world assets at scale across alternative assets, capital markets, lending, and payments. As of 2023, more than $12 billion in financial asset transactions have been supported by Provenance Blockchain. So as far as our conversation, Anthony and I are going to be touching on all of these issues, and really just want to introduce you listeners, in case you're not aware of this, to the fact that household name financial institutions are getting into this space. You know, it's still cutting edge stuff. There's a learning curve involved for all the various parties, but it is definitely the future of finance to say there's going to be plenty of financial transactions, not just, cryptocurrencies, but like bread and butter, buying real estate, buying stocks, buying bonds, that this is all going to be at least available over various blockchains in the not too distant future. And so part of what we're doing on this podcast is introducing you to the people who are making it happen. And so without further ado, here is my conversation with Anthony Moro. Anthony, welcome to INFI.
Thanks for having me, Bob. Great to be here.
Yeah, I'm very excited. I've been looking forward to this. So the main purpose of our talk here is going to be to explain to people the sorts of things you guys are doing over at Provenance. So why don't we just start out with, can you just give, for somebody who doesn't have any familiarity with it, what is it that you guys do?
It's fair enough. And it's a very common question. Not a lot of people know what we do. It's a new technology, obviously, particularly in regulated financial services. And we're in the first inning of, I think, a revolutionary change. And I'll talk a bit about that as we go through. But at the end of the day, the best way to think about what a blockchain is it's really just a registry and a ledger. It's a big database, if you will. And when I started in financial services, databases were kept on paper. And then they moved to a Excel spreadsheet. And then they moved to an on-premises data center. Then they moved to an off-premises data center, and then eventually they moved to the cloud. And this blockchain that we're operating is really just the next iteration of that, obviously with new bells and whistles each iteration. and this is obviously the most sophisticated form of database that there is, properly built for financial services. But Provenance at its core is something called a layer one blockchain, which means we're self-sovereign, which means we control the software that sits in our blockchain protocol. And we like to say we're properly permissioned and purpose-built for regulated financial services use cases. So Provenance was founded in 2018. So recent technology, obviously, with Bitcoin being the first real use of the digital ledger, evolving into what we have today, largely in the crypto space. But obviously, we're regulated financial services use cases, and crypto is a bit older. Regulated financial services is all pretty new. So we've since grown since 2018 to become the largest real-world asset public blockchain. And today we've serviced about $15 billion of financial transactions. And we currently have around $8.2 billion in value ledgered across financial assets such as loans and equities and funds. And while $8 billion might seem like a big number, in the general construct of $500 trillion of financial assets in the world, it's a drop in the bucket. And we have a very long way to grow. So just quickly, what does purpose-built for financial services mean? Well, nearly all the blockchains that you may have heard of, like Ethereum or Avalanche or Solana, are general purpose networks.
Hey, Anthony, can I just explain? Why don't, if you don't mind, can we just pause? Because I love how you started out with it used to be like an actual paper database and then Excel spreadsheet. Once they had, wow, this is revolutionary. You're not going to make simple arithmetic errors. This is amazing. And then, off-site. So if there's a fire and we lose all of our floppy disks, then, we've got backups across the river and then the cloud. And can we just focus? Because I know so much of this is going to get into the weeds, but I know there are people out there, they don't really get, what do you guys mean when you say blockchain? What, I think they think that means the internet. And it's, you know what I mean? So it involves the internet, obviously, but that's not the definition of it, because obviously you could do something on an Excel sheet and communicate with people over the internet. So can you just, in your words, because in other episodes, we've tried to do this too, but I'm just curious to hear if somebody says to you, over drinks or something like, Anthony, I've heard about Bitcoin for 5 years and I missed the window to ask my buddies about what the heck is a blockchain? What does that mean?
Sure. Great question. So at its core, it's a distributed ledger. And what is a ledger? Is a database or a list of transactions in our case. And instead of being centralized, it's distributed. And what does distributed mean? That means proof of work and proof of stake are two types of blockchains. The Bitcoin is proof of work. Most of the blockchains are proof of stake, meaning in our case, there are hundreds or dozens of what's called validators, which are essentially just computers running a copy of our code in various locations all around the world. And they're independent of us as Provenance Blockchain Foundation, which runs the protocol. And they serve a purpose of proving transactions cryptographically, meaning if I trade a token to you and you trade it back to me, that transaction is written to the blockchain, and essentially that transaction is there forever and it's immutable. It can never be changed. You can go back and look at it, but it can never be changed. And that permanent record is then kept on those dozens or hundreds of validators on dozens or hundreds of computers all around the world. And they all use the software to agree that that is an appropriate transaction. And that core is blockchain, and you can build smart contracts into it and do lots of useful things with it. But at its core, that's distributed ledger technology.
Okay, great. And you had mentioned that distinction and between proof of work and proof of stake.
Yeah.
And that is, am I right in saying that's the way? So the blockchain is a chain of blocks, hence the name. And like you say, there's many copies on different computers around the world. So if any one of them gets taken out, that ledger still exists.
Correct.
And can be, recovered. And then is the proof?
It's pretty much unhackable. I mean, I'm obviously not a cybersecurity expert, but if you have hundreds of computers in hundreds of locations around the world, all running the same copy of the same software, theoretically, you need to be able to hack something like 51% of those computers in order to gain network access, which, while not impossible, I think is really, really hard depending on the number of validators in the node. If you wanted to run a blockchain with 6 validators, then it's a different story. But if you have hundreds, it's really, really impossible to hack the network.
Right.
It's safer, faster, and cheaper than traditional financial services.
Yes, exactly. And so the proof of work versus proof of stake is That's showing like the method by which somebody can validate the addition of a new block to the chain and
Correct.
make it one block longer.
That's
And that's
exactly it. And the industry obviously started with Bitcoin, and that was proof of work, which is why you have all the ecological issues around the masses of computers that compete to build the next block. And that's where the energy consumption comes in. And that's why Ethereum moved from proof of work to proof of stake. Proof of stake is a lot more energy efficient, and that you just have a network of scores of computers around the world that all keep a very light copy of the database on each of their systems, and it really isn't that energy intensive.
okay, great. Yep. Okay, so I had interrupted you in mid-flow there just to make sure we didn't lose somebody at the starting
Nope.
line about what's
Quite
what
all right.
actually is a blockchain. Okay,
So
so
keep reeling me back in. That's cool.
so you were saying you were a layer one, and then
So what makes Provenance? Why are we purpose built for financial services? So I was trying to explain that most of the major blockchains that you may have heard of, like Ethereum or Solana, are general purpose networks, right? So what that means is they need to have a software that is basic enough so that you can put a large variety of use cases, such as crypto speculation or those goofy digital art NFTs, those bored apes and those things, or games or crypto trading. You need to put a lot of things called smart contracts on top of those blockchains. And smart contracts are just pieces of code that are written by third parties that do something very specific. And generally they're pretty safe, but not, infallible. And you need to put a lot of smart contracts on top of those base protocols in order to do something specific. Provenance is a bit different in that most of those functions that you would need for financial services are baked into our protocol. So it makes it a lot, safer. And what we like to go back to is cheaper, faster, and safer.
and so Provenance it is designed like with financial industry or services in mind.
Specifically, it's a blockchain. It's a network. The way I like to think of blockchain, and it's a oversimplification, as you can imagine, is when you go out and you buy a new computer, whether it's an Apple or a Microsoft, turn it on and you get the basic operating system. From there, in order to make it useful, you need to run programs on that basic operating system. We, as a blockchain protocol, are just an operating system for financial services. If you want to loan marketplace, or you want to do bond trading, or you want to put up some equity distributions, all of those can be smart contracts on top of our protocol. All those are programs on top of the operating system.
Okay, so in principle, you could go do it on the other ones, but you had to be building more, whereas yours is that was designed for.
That's exactly it. That's exactly. We're just more. Some protocols are great for crypto trading. Some are great for those bored ape cartoons. We're great for financial services.
Right. Okay, now you had said a very interesting phrase a minute ago. You said real world asset. So can you explain? And this is, it's the kind of thing like once I hear that, like I just see it. Everyone's talking about it now. Can you explain what that is for people who are not used to that phrasing?
Sure. So it is if you think about the financial services world, and I built my career in financial services, the front ends are pretty attractive. You go to your banking app and you have an app on your cell phone and it looks pretty cool. Most of the interfaces are pretty recent. I can tell you the middle and back office technology that banks and large asset managers are built on is 20 or 30 or even 40 years old in some cases. Part of the reason for that is there's been a lot of consolidation in the industry, and banks and asset managers have just bolted on lots and lots of systems together, and they're held together really with duct tape and baling wire. It's pretty tragic if you really could understand what goes into middle and back office at a lot of financial services firms.
And in some cases, injections of liquidity from the Fed is keeping them up too.
I mean, they've all had some issues, not necessarily related to technology, but risk for sure. But also because you don't have line of sight on all those assets, they're all housed in bespoke systems at bespoke financial institutions. You really don't have a holistic picture, nor does the Fed have a holistic picture of what's going on in the loan market, the residential loan market, for instance, that caused the great financial crisis several years ago. So where do I think we're going to go? I think all financial assets will be tokenized over the next 5 to 15 years. I think we're in the first innings of a process that really will reshape how value is transferred and settled and stored. And what does that mean to the regular person? It means financial transactions will be more efficient, And what does that mean? It means, hopefully when you go to apply for a mortgage or a home equity loan, you're going to get lower rates because there's fewer intermediaries taking a little piece out of every time you do a transaction. We buy and sell a share of stock. There's 7 parties in between you and the seller. And when you go to you go to Walmart and you swipe your Amex card, there's 5 parties between you and the merchant. In blockchain, none of those parties really need to exist because blockchain replaces trust with truth, and it allows bi-party, immediate, atomic settlement. And those two things are, they sound sort of esoteric terms, but they are the foundation of the financial system. And if you can solve for those two things, you can reorient the financial system and take out a ton of costs and make it a lot cheaper, faster, and safer for everybody involved.
Well, that's great. I'd like to unpack those two. That was so. The blockchain, it replaces trust with truth.
Yep.
So, and the problem with these sorts of interviews, Anthony, is half of the audience, they're going to be experts in this, and they're going to want to hear what's the latest cutting edge news from Anthony. And then other people, like I say, I don't want them to just feel like geez, I wish somebody would explain to me what a blockchain is. So why don't we just for the people that say, oh. It replaces trust with truth. What does that mean? That I can't trust Provenance? What are you saying? Obviously, that's not what you mean. So can you unpack that? What do you mean it replaces trust with truth?
So when again, I'll go back to the stock example. If you're a seller of 100 shares of Amazon and I'm a buyer of 100 shares of Amazon, there are literally 7 parties between you and me. You can't just sell me 100 shares. I can't just buy 100 shares. Between you and me, we each have a broker. We each have a settlement system. We have a clearing system in the middle. Each one of those parties takes a small fee. And it takes 2 days for that transaction to settle. You owe me your securities in 2 days. I owe you the money in 2 days. 2 days to settle that transaction. If you think about that, that's an incredible amount of time for something that should be very, very simple. And all of the intermediaries exist for a reason. They exist because I don't know who you are, so I don't trust you to deliver the securities when I'm delivering the cash. I don't trust you to give me the Amazon stock when I want to buy the Amazon stock, and you don't trust me to give you the money. So we need all those intermediaries in between, and they all have processes, and they all have things like reconciliation that they need to do before the transaction can be valid. And they don't need to exist in a blockchain world. In a blockchain world, you have 100 Amazon shares, you post them for offer. I have the appropriate amount of money to buy those shares. That money gets ledgered and escrowed. And when we press the button to make that trade, you have a bid, I have an ask. When we atomically meet to make that transaction, blockchain will swap out cash for the securities, and no one else needs to be involved in that transaction. That's the revolutionary potential. It cuts out every one of those 7 counterparties. You go to Walmart and you want to buy, a lawnmower. So you can hear the guys outside right now. If you don't hear them on the podcast, you want to spend $500 on a lawnmower. You swipe your Visa card, and there's 5 parties. I have a bank, you have a bank. Walmart has a bank. The credit card companies are involved. There's 5 parties in that transaction. Each of them takes a small fee, and now you pay 3% for that credit card fee. Everybody hates it, but Walmart doesn't trust you to give them the money when you deserve to give them. They can give them cash, of course, but they don't trust that you're going to swipe your card and pay them. And all that is wrapped up. So if you could then swipe your card and automatically, again, the blockchain will hold the money in escrow, and you can pay it now or you can pay it in 30 days, whatever the terms and conditions are. But Walmart will know that money is coming to them. It's trust versus truth.
Right. And maybe just to use a goofy analogy, because a lot of this stuff people just take it for granted and it happens behind the scenes. And so they maybe have never thought through. But imagine folks like on, I don't know, Craigslist or Reddit or something, you arrange like, oh, I have shares of Amazon I want to unload. And so I'll meet you, and you meet him in the park. And he comes out with his personal checkbook and writes a check to your name for $20,000. Says, there you go, I'm good for it. And you in turn hold up, some Post-it note that says 10 shares of Amazon, good for it. And you stamp it with, some firm down the street, Joe Blow Incorporated. And then, gee, I don't trust your personal check and I don't trust that. And then some other guy from the park walks up and says, oh, you both give those things to me and I'll hang on to them for a week and make sure they're legit. And then I'll give them, and obviously none of that works because we don't trust each other. Yep. And that's the function of these big institutions that well, no, it's at the store. You swipe your debit card and it's they're communicating with the
Correct.
bank that they trust. And so if the bank says, oh yeah, this guy's good for it, it's in his checking account, they trust it, even though, like you said, legally speaking, the banks say so is not as valid as a $20 bill, a green piece of paper. So,
I mean, and that's the way it works. It works with cash because you can give them cash. There are security features built into your dollar bill, so they know that it's a valid transaction. They're going to check, but you can't do that. That doesn't really scale. Cash in person doesn't scale.
Right. And so, intuitively, with the blockchain, as you say, because it's a public ledger, that means anybody can inspect it. So you're not, when they say it's a trustless system, they're saying it's not that you have to rely on the goodwill or the competence of some big institution. It's just, no, it's up there. There's dozens or hundreds or thousands of independent people running their computers around the world that these things have been verified. And so if that's what the blockchain looks like right now, then this guy's saying, no, I'm the rightful owner of 10 shares of Amazon. You can see that, yep, that's pointing to that. That stuff is really there. It's housed there. And then the smart contracts, it's all, the protocols are all agreed upon ahead of time that when this event happens, then my money transfers to him and the shares transfer to me.
That's it. That's exactly. I mean, it's nothing magical. It's just the next iteration of technology, right? Before credit cards, you had ATM cards, you had cash. I mean, you wrote checks. It's just the next iteration of technology. It's all it really is.
Mm-hmm. Well, I think you're right. There's nothing magical, but when people, like when we explain how it works, oh, okay, but then in practice, I guess really the intellectual problem, the last thing was what Satoshi Nakamoto solved with the Bitcoin white paper, right? The idea of, how do you prevent the double spend problem? Like, we can talk about, but strictly speaking, how is it that the community can have this ledger and we can all agree that, oh yeah, I'm so-and-so and these are my, I'm going to digitally sign that. It's a little bit tricky when you pull up the hood and want to understand literally how that works.
Yeah.
But if people understand the basic idea, that's what you build on. So let me ask you this then. I kind of just backed into this question. I've heard people say, I'm just wondering what your take is. I remember like back in, 2011, let's say, once people started understanding, oh, wait a minute, we're going to be able to do like contracts and things on these public ledgers. And I remember one guy saying to me that he said, no, the issue with Bitcoin's not Bitcoin. That's nothing. He thought 50 years from now, looking back, they're going to think the revolution in the 2008 white paper from Satoshi was inventing the blockchain, of which Bitcoin happened to be the first use of that. That he said, it's the blockchain that is the underlying new tech. That's like the fire being given to man sort of thing.
Right.
So how do you feel? I'm not trying to back like, how do you feel about that?
No, 100%. It's what was the first? ARPANET was the first internet. It was a system for labs to communicate to each other, and that evolved into the World Wide Web, which evolved into the world that runs the way that we do it today. If you tried to explain ARPANET to someone, whatever year it came out, they'd be like, "What?" They wouldn't have any idea.
Right.
And so it's a lot like that now. I think that was more revolutionary. Obviously, the global network that allows anyone to communicate with anyone is, it's the invention of our lifetime for sure. And this certainly builds on that, and it uses that, and it's an offshoot of that. But it's just the next evolution. We shouldn't make. Satoshi's white paper was brilliant. Bitcoin is brilliant. I'm not a believer in cryptocurrency for itself having a significant amount of value. I see the use case for it. I see especially outside the US, when you want to hold value, that's not particularly easy to hold value in many countries. That stable value that isn't part of the government's purview. In the US, that's less important to us with a strong dollar and a stronger banking system. But I see the value of Bitcoin globally. The meme coins or coins, I don't know if I can curse on this podcast, but those things are...
Well, I'll check it. If you can, we'll bleep you retroactively.
Those things are a joke, I think. I think the first use cases of the internet were, gambling, pornography, all the bad stuff that, that humans can think of. Those are usually the first use cases of any new technology. And, the blockchain world, the crypto world brought in a ton of scammers. And we're seeing a lot of that today with that Sam Bankman-Fried guy and Alex Majitsky. There's just a lot of hucksters out there who are separating people from their money. And with any investment, you need to really understand it. And most people don't. within the crypto space. And yeah, but crypto is very, very, very different from what we're doing in financial services blockchain. I just need to make that extraordinarily clear.
I'm glad you.
We use a similar technology, but it's
right.
extraordinarily different. The things that we bring are regulated by the SEC. I don't have an issue with token or governance in the crypto world. I don't think the FTXs, I think they are securities exchanges. I think a lot of what's going on in the crypto world should be governed by the SEC. The SEC has to evolve to allow for it because crypto, the blockchain that we operate does not fit nicely into an existing Securities Act of 1933 box. Obviously, in 33, they didn't know the internet. They certainly didn't know blockchain. And it takes a while for the SEC to catch up. They're working hard at it. I wish they would move a little bit faster, but they're moving appropriately. Their job is to protect investors. And obviously, a lot of investors have got scammed out of a lot of money in the crypto space, and we are adjacent to that crypto space.
Yeah. I'm glad you emphasized that. And that's partly why I was bringing it up was that, my anecdote was real. I didn't make up a fake story,
sure.
But someone really did. But I don't know if this analogy works. Maybe it's like saying they invented the printing press, and I think probably the Bible was the first book that was really mass produced, but the printed book is not the same thing as the Bible, right? Yeah. And so even though Bitcoin was the first thing that was like launched on this new medium of blockchain and Bitcoin or even cryptocurrencies in general are not synonymous. One's sort of like the vehicle or the platform, and then Bitcoin happened to be the first thing that was put on it, but you can have different blockchains that house different types of information and also circling back too. So when people say real world assets, they mean as distinct from purely intangible. Well, it's not even that because a share of stock isn't kind of intangible. They mean so Bitcoin's not a real world asset. When people say real world asset, they mean as opposed to cryptocurrencies, for example, because those things don't point to some physical economic. It's just it's just this ethereal thing.
Yeah, it's not a great term. It's not all-encompassing. I wish there was a better term for it. Digital cryptocurrencies change first of all, they're not currencies. Crypto, whatever you want to call it. They're called cryptocurrencies, but they're not currencies.
Yeah, media of exchange.
Assets are a terrible vernacular. I wish it didn't exist. The decentralized and centralized exchanges that trade these things are not exchanges. They're not governed under the SEC and FINRA regulations. So the crypto industry was devious and smart in that it took on the names of TradFi processes and brought it into its own world. And the vernacular caught on, and it probably shouldn't have, but it did. So you still think of what Sam Bankman-Fried ran next to the NASDAQ. What the NASDAQ runs versus what FTX was, night and day different. NASDAQ is
right.
fully registered national exchange. FTX was a house of cards. One is, NASDAQ is hugely regulated by multiple regulators, and FTX was a party house in Bermuda. You got to know this stuff before you invest on this stuff. So I forget where my point was.
Well, I was trying to get you to just to, again, hammer home on like when we talk about real world assets being on the blockchain, when we say the real world, what is that phrase? Meaning?
The way I think of real world is, stocks, bonds, loans, credit, private equity, private debt, funds, ETFs, even money is a real world asset. Things that are not crypto. I wish it was not crypto instead of real world assets, I think. But these are the things that are reasonable things to invest in for most investors. Right? You have the 60-40 portfolio, which is 60% stocks, 40% bonds, which has been pitched forever. And that construct is gone and dead. I think one thing that financial services blockchain does is it does democratize access to alternative investments. And if you consider everything except stocks or bonds to be an alternative investment, now for the first time ever, you will have reasonably priced per share, and $1,000, $100, whatever. Real estate, commercial real estate, residential real estate, mortgages, credit, private equity funds, assets that you and I as regular investors wouldn't ordinarily have access to. You'd have to be an institutional or a large family office to have, Goldman Sachs' wealth division, give you access to the special deals in the blockchain construct, democratization of all these assets. So for instance, one of the asset builders on Provenance is Apollo. And while they're not there yet, they're obviously the biggest, one of the biggest private equity firms in the world, one of the best track records of any investors anywhere, full stop, one of the best reputations anywhere, full stop. They've tokenized funds on Provenance, and they've stated that their intention is to have lots of funds traded on Provenance to the point where the price per unit goes down significantly. And then more importantly, generally when you invest in private equity, you buy whatever amount you want. And then generally it sits there for 7 years, the entire length of the fund. You might get some distributions, you might get some capital calls, and at the end of the fund, you get redeemed and the fund does it again. Blockchain allows potentially, so we're not there yet, but potentially the ability to trade in midlife. So I could trade my Apollo fund to you 3 years after, not have to wait for 7 years. I could also now perfect it and lend on it, which is also a really good use case because generally right now you can't lend against your if you hold real estate securities or private equity securities or any other alternatives. It's hard to use those as collateral for a loan. And in the blockchain world, you can get a valuation, you can get ownership perfection, and you can lend against those assets that you hold. So making capital markets and capital a lot more efficient is some of the things that blockchain does as well.
Okay, great. So just on that last point, we could expand on that. So you're saying some people, they might own real world assets, and if they have them in the conventional way, it might be hard to sort of tap the liquidity of them to have someone lend against it. Whereas with blockchain, it becomes easier. So can you just elaborate on that a little bit? Like why? I can imagine someone saying like, I understand the word you're saying, but I'm not seeing it. How come if I have on this blockchain thing something pointing to my parcel of real estate, why is someone going to lend to me against that more easily? Or
sure, because they can trace the provenance, the ownership of it. They can know for a fact that you own it for real. They can see the whole, if it's digitally native, they can see the whole creation of the asset, the fact that you purchased the asset, when you purchased the asset, that you continue to hold the asset. They can see all the terms and conditions of the asset all on chain. And then you will have a market, just as you do in the crypto market today, but there is a market for real world assets. You can perfect your ownership and lend against it. So generally, if you own a PE firm right now, PE shares of an Apollo fund, it's really hard to lend against that asset. Really hard to say, got $100,000 of an Apollo fund. Will you, Bob as a person or Chase as a bank, will you give me 50% loan to value? Will you lend me $50,000? And as collateral, if I default on my $50,000 loan, you can take half of my $100,000 investment in the Apollo fund. Generally, you can't do that today. In the blockchain world, it makes it much easier to do those sorts of things.
okay. And if you were to do it, you would have to do things like they would have to search like a title search to make sure you're the owner, look to see are there any other liens already existing on it. But you're saying once it all lives on the blockchain, you can check that in 2 seconds.
Correct. And you might not, some of the terms and conditions, you might not be able to lend against it. It just makes it, there's just a lot of nuance, which I won't get into, a lot of financial nuance, legal nuance that just makes it so much easier when they can see all the assets in one place.
Okay, great. So now you mentioned, earlier you were alluding to the fact that some people were playing naughty in this brand new space, partly I think because in the beginning regulators didn't even, I know some guys like they went to Congress, I don't remember what year it was, early on testifying on like what Bitcoin was and just the questions we were, looking at some of them and they didn't even know what the heck that this was. This was back in the day when the thing was 3 years old. And so they've caught up since then. So can you just speak to what's the state of the regulatory apparatus in the United States, at least with regard to digital finance or blockchain specific financial services and how that's evolving?
It's a broad topic. So I feel comfortable that most of the regulatory construct of the world that I operate in is existing. So again, regulated financial services, and there are various SEC rules that govern the sale of securities, and the SEC generally doesn't opine on the technology used to ledger those securities. So some of the more popular offering regulatory constructs are Regulation D for private assets, or Regulation A+ for a crowdsourcing asset, or S1 for a public IPO. All those regulations exist, and we are working with firms that are operating that construct. And that's all real world asset stuff. Where the regulations haven't caught up is, for instance, how do you treat the blockchain protocols themselves. So how do you treat Bitcoin? How do you treat Ethereum? How do you treat Provenance Blockchain? We're happy to register as a security if we could register as a security, but the construct of the way blockchain operates doesn't necessarily allow that because, for instance, all proof of stake blockchains use a token to compensate validators for performing the work. Again, the foundation doesn't manage all those validator networks, the 50 or 100 or 2,000 validator networks. Those are independently run in an open source manner by people or entities literally all around the world. And they get compensated for maintaining the software and the energy it takes to run the computers by the token that is native to the protocol. So our native protocol token is called hash. And if you have a validator and you're in France and you perform a transaction, we will automatically get hash as compensation for your transaction. And you can sell that hash for cash in order to pay some of your expenses, or you could continue to hold it and hope that at some point it'll go up or you could use it. That's why they exist. But the protocol can't pay you in securities if our underlying token is now a registered SEC entity. If that's our shares, not legal to pay third parties in securities unless the third party is a broker-dealer. So the validator in France isn't going to become a U.S. broker-dealer just so we can pay them in securities.
Right. No, but I do understand why you're explaining there's some complications and in terms of the classification that you're right. Just like Google paying the lawn care people that cut the lawn or something, they're not going to pay them in shares of stock. Like that would be weird.
It's illegal. Right? Yeah, it's illegal to do that. So
you would have to hire a brokerage that also did double duty as a lawn care.
Well, the lawn care guy would have to be a broker-dealer.
Right, yeah.
And it's just, we welcome a construct, but there isn't one. And then on the crypto, just to finish the question, onto the crypto side, the regulations are also pretty clear. There's national regulation at a national market. So you can register as a national exchange. You can register as an ATS, an alternative trading system. But then our crypto, are they securities or are they commodities? The CFTC and the SEC need to come to some kind of an agreement or structure.
Okay. So if we're talking now strictly narrowing the focus for securities that are traded on the blockchain, in terms of the regulation of that, again, you talk about the U.S., do you see any major changes coming in that over the next 5 years, say, or do you think they pretty much settled down as far as getting their framework down?
Hard to say. I hear views all over the place. We'll get a quick resolution before the elections to nothing will happen until after the elections. There's a ton of opinion. There's no fact. It's Congress. Congress doesn't act quickly, particularly in this environment. So I'm not holding up my breath. We at Provenance, we try to do things the right way. We try to be, what's called a good control location, which is a custody term, which is trust us with your financial assets because we will protect them kind of construct. We act more like a custodian bank than we do a cryptocurrency platform.
Right. Okay. And I think it's worth mentioning, though, that there are household name financial institutions that are getting into this space. It's not, in other words, the idea of putting real world assets onto the blockchain. I mean, this is not some newfangled thing that is completely science fiction that is going to stay in the corner for 20 years. I mean, are you comfortable saying this is clearly the future of finance? This direction?
1,000%. Yeah. So I'll give you a good example. So Figure Technologies founded the Provenance Blockchain, and they have built a business in home lending, particularly around home equity lines of credit and mortgages. And what they've done is they have since issued literally billions of dollars of HELOCs. They're issuing a couple of $100 million every month in this environment because not a lot of people are doing cash out refis. If you need money out of your home, you're doing a HELOC. So from origination of the HELOC to distribution via a warehouse or asset-backed security, Figure has pretty much taken over 110 basis points out of the cost of that transaction. More efficient, less expensive. And because of that, they can offer lower rates to homeowners. And they can build a moat around their process that is a massive competitive advantage to every other home equity line of credit lender in the marketplace. And as a result, they've had 5 of the top 10 home equity originators adopt their software, which is all in Provenance. They've already changed that industry. If you're still issuing HELOCs the old way, you're a dinosaur and you don't even know it yet. So you're seeing things like that happen. That's a great use case. Yeah. Receivables are another great use case. Trade receivables, invoice receivables, they operate on we talked about trust versus truth. The reason receivable rates are so high is because I don't trust you to show up when you need to show up, either with the money or the invoice. And rates are really high to compensate for that risk. But if we can change it and I can ensure that you'll show up and you know that I'm good for the money, we have a much different construct and much lower rates. Lots of other use cases, from private equity funds. I talked a bit about that, to InsurTech. There's a lot of really cool stuff coming down the pike. New industries and reinventing of old industries.
So can you, to the extent, I know some of the stuff might be proprietary or whatever, but are you able to speak on any of the exciting new projects that Provenance is shepherding in, just to give the listeners an idea?
Yeah, I mean, those are some of the industries that I just mentioned are where we've been focused. Not everything is wonderful in blockchain land. So, for instance, the stock, the Amazon example that we spoke about isn't going to happen soon, right? It's more of a 5 or 10 year process before equity trading is really disrupted, and it doesn't make sense. But most people, as you were saying at the beginning, really don't care that the trade takes 2 days and there's 7 intermediaries in between it. My experience on Charles Schwab or Merrill Lynch is fine, and I get my stock when I get my stock. It's really the more broken private assets. So private equity funds, for the reasons that we spoke about, for trading and lending, new products like whole life insurance, which is really interesting. I think there'll be some cool announcements there coming out soon. Yeah, the lending markets that we spoke about with Figure. Figure really is a pioneer in the space. They've done a lot of things that nobody else has so far, and they're going from strength to strength.
So I'm fascinated by your remark there that the trading of equities, you think in this area, is still it's not going to happen next Thursday. Is it purely just because the demand's not there, because for whatever reason the public is complacent, or is there other things too behind the scenes that you can just see this is going to take a while?
Yeah, so coming from a big regulated bank, so I began my career at BNY Mellon, worked there for 20 years. The systems are great bank, great people, horrible technology, trying to fix it. But the process, BNY Mellon touches 25% of the world's investable assets, I think was the last stat that I heard. And their systems are ingrained into everything the financial services industry does. And they're industrial grade. They're always up. They never break. And safety is at the core, right? And that's what you need to think about. The risk is as low as it can be. The safety is as high as it can be. And it's just going to take a while to unwind all that. Plus, and this is important, the banks and the financial services firms have almost no interest in seeing 7 intermediaries turn into no intermediaries, because their business is being that intermediary, and they're innovating themselves out of existence, and nobody likes to do that.
That's what I was wondering, if part of it was that there's a lot of wealthy institutions that are sitting in the middle of that right now, and they might do various things to try to slow the process while raising perhaps legitimate concerns. Not purely cynical, but saying, well, gee, this system that we got up and running here, it took a long time to build it, and it kind of gets the job done before we just scrap it and go for something new. Can you speak to, just make sure people are understanding the logic, to say, 100 years from now, if people are trading shares of corporate stock off of a blockchain, does that mean would there still be like the New York Stock Exchange, and then these blockchains would be a layer above that? Or do you understand the distinction I'm making? Or would it just be?
So it's a good question. It depends on how much handholding you want. So today on an ATS, you and I can trade a security. If Amazon was listed, for instance, on the Figure ATS, you and I could trade amongst each other, and we could self-settle and self-clear. meaning we don't need any other participants. You say you want $100 a share. I'm fine with $100 a share. I give you $100. Transaction is done immediately. Now, for regulatory purposes, it needs to be on a recognized national exchange or an exempt like an ATS. So that will still exist. There'll still be technology that is regulated, and it should be, to create a fair market. Amazon itself will still need to file 10Ks and 10Qs if they still exist, or a version of those, to register with the SEC in order to ensure that they're not taking advantage of investors. But you don't need your broker, right? You don't need DTC. You don't need the clearing firms in between. You don't need custodians. If you're comfortable holding in a wallet, and whatever the version of a wallet is, I'm comfortable doing that. When I place a trade, I don't really think about where. I mean, I do because I'm with the industry, but most people don't think about where it goes and what happens to it, right? So as long as it's all about UI UX. As long as the UI UX is great, nobody really cares about what happens behind the scenes as long as they know it's safe.
Okay, right. You had mentioned your prior experience, and that was something I did eventually want to get back to. So maybe now's the time to ask. Can you just speak a little bit before you got into your current role?
Yeah.
Like, what were you always in financial services, or did you used to be a poet? How did you come to be?
I went windsurfing for a while. No, I pretty much started at BNY Mellon in the 90s. So I've been around for a while. And I had a group called ADRs, American Depository Receipts, which are non-US equities trading here in the US. And I was fortunate enough to help build that business from really zero to where it is today, which is $1 trillion asset class. If you buy, Alibaba or Nestle or Vodafone on the New York Stock Exchange today, you're buying a New York. And none of that existed when I started back in this business. So I was fortunate enough to be able to travel around the world to, help companies and build their capital bases here in the US. And it was absolutely fascinating. So, but I got a good experience in financial services, how securities trade, what different regulatory regimes look like. And that was really the basis for that. Blockchain hadn't really been a factor with the later part of my career, 2018, 2019. But then I went over to run a real estate investment trust, a REIT, that was listing on the New York Stock Exchange. And then I met the Figure CEO, a guy named Mike Cagney, who is a revolutionary visionary for all things blockchain, and you should try to have him on your show one day. He's quite a character as well. And his vision of the future sold me instantly. And I know for a fact that blockchain is going to remake financial services over the next bunch of years. But I was never a crypto guy. I don't own any cryptocurrencies. Just not for me. I don't understand the business model very well. Don't understand the reason for buying them super well. I appreciate the technology very much, obviously, because I'm in the business, but I just think there's too many bad actors and too many bad projects that they've tainted the entire industry as an investment for me. But yeah, I think the technology is brilliant.
Well, great. I guess the last question here, I'm respectful of your time, is I'm wondering, a lot of what we've been talking about is, okay, there's a blockchain, people do stuff in the real world, and hey, if we just took that and kind of the same business model, but then just put it onto the blockchain to get some efficiencies, cut out some middlemen, things like that. But is there, are there things that are opening up that are completely new that only can be done on a blockchain, like investment strategies or just types of transactions, that it's not just a better analog of the real world version? It's like do you understand the distinction I'm making?
There's a ton of use cases that could never have been done in the real world that will be done in the blockchain world. And it runs the gamut of investment options. If you think about why we have the 60-40 portfolio, I'll keep going back to that, is because the only two-sided marketplaces with any kind of depth of liquidity you see are stocks and maybe bonds, some bonds, because they're still not a great marketplace. If you can get to scale with enough financial services firms, enough asset managers, enough investors, all together in one place with a regulated construct and a marketplace that allows you to trade both securities and non-securities, crypto, in one place and you can bind that whole marketplace together with a digital version of money, then you've got, Coinbase 2.0 plus NASDAQ 2.0, all bound with stablecoin 2.0. You need better versions of all three of those, better versions that exist right now. But if you have that construct, everything I do is digital. Everything immediately settles. There's no counterparty risk. My digital dollar yields like a money market every time I hold $1. So I'm getting $1.05 a year instead of $1 a year. You don't have to think about moving it into a money market. I can lend against my assets. I can perfect against my assets. I can do everything on one platform. That this platform doesn't exist yet. It's going to be built with incredible user experience. And again, my rates will be cheaper. That'll be because a lender will see that I own the Apollo private equity fund and a Blackstone real estate fund, and I have this much cash in a money market, and they'll see a holistic financial picture if I let them. Of course, not everyone, and no one will see it if I don't let them. And they'll say, because these assets, you can use these assets as collateral, and I'm going to lend you, a personal loan might have been 12% if I didn't know exactly what you own, but now that I see your assets, I'm going to lend you at 4%. And these are the sort of killer use cases that don't exist in the TradFi world because of the disparate amount of systems that don't talk to each other. In the new world, when we get there, and I know we will, it's not if, it's when, that UI UX is going to be wonderful, and the amount of understood lending that can go against that is incredible. And that lending can then be used to either invest in the next Apollo fund or put my kids through college or whatever I want to use it for. And again, lower rates to investors and borrowers is a win for everybody. And the only people who lose are the intermediaries. And who feel sorry for the intermediaries, right?
Right. Yeah, it's very exciting. Just because as a theoretical economist back when I was, in academia, there would be all sorts of little thought experiments that would come up about social like if the government didn't pay for fireworks, how could that happen? And you could say, well, in theory, you could have a contract that if at least 10,000 people kicked in $5, then it would get funded. Otherwise, everyone gets their money back. But it'd be such a pain to set up something. But now it's like these sorts of things are going to be crystal clear and easy to set up. Yeah. That it's just amazing how much is going to become possible because transaction costs are coming down and everything's going to be self-policing and self-enforcing. It's really just, it's hard to even, the mind boggles, as they say, when you think about the future of this. And it's pretty close.
Yeah, it's so much fun. It's the funnest thing I've ever done, the most interesting thing I've ever done. The mind exercises that you can play. I mean, the crowdsourcing of the Constitution, they tried to do that a couple of years ago. I thought that was really cool, right? A bunch of people did get together and put $5 in and tried to buy a copy of the U.S. Constitution. I think Steve Cohen or someone outbid them. But they put in a couple $1 million, and I thought that was a cool use case of that, right?
That's funny. I hadn't heard that one.
It enables really cool things. I mean, things that you never even thought of. And you can just build that. What we're just trying to be is the neutral layer one platform, the operating system, if you will, and people will build really cool stuff on top of it.
Well, I'm excited to see the future, and I know that you're playing a key role, Anthony, in helping bring it closer to us. So thank you for your time and your efforts and everything you've been doing.
Love it, Bob. Thanks for having me, and you guys are doing a great job, and love to see where you're going to go next.
Oh, thank you. Folks, you've been listening to Anthony Moro, the CEO of the Provenance Blockchain. Thank you for tuning in, and we'll see you next time.
This concludes another episode of INFI, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit INFI, thefutureoffinance.io. Thanks for listening.